Lars, great to have you back with us here at Marhelm.
Well, thank you for having me.
And we've been seeing some tweets, and we know that you've been to the Marine Money Conference. You just came home back to Oslo, and maybe you could start by recapping a bit the main takeaways from the conference.
Yeah, no, sure. First of all, it was a very well attended conference, and I think kind of Marine Money in New York in June is kind of the I think from the banker and investor side, probably the biggest event there is for shipping, and it was great interest. At least I was fully booked with the investor meetings and so forth. Actually more so than last year, which is encouraging. So it's it's definitively so that the US or the Wall Street has woken up to tankers as well. The few kind of bits and bobs that came up is actually one that I wasn't really prepared for and hadn't really thought much about. It's obviously the US election. How is Biden versus Trump going to affect the dynamics in oil and then in global policies and then for shipping? And I was kind of unprepared for it, potentially because I think the answer is that it's kind of borderline neutral, whether if it's Biden or Trump that kind of takes the seat after this election. The general consensus was potentially Trump will be more aggressive on Iran, but he could also be more kind of firm in order to find a solution, or at least some sort of agreement with regards to Russia-Ukraine conflict, maybe draw a line. But this is obviously very speculative. For US production, the saying was that frackers are going to frack irrespectively of Biden or Trump, but obviously it's going to be easier potentially to kind of be a part of that industry under a Republican rule rather than a Democrat rule. But anyway, it's that was kind of not the big theme. It was more a discussion. Obviously, at the top of everybody's mind was Red Sea, Gulf of Aden. I had to reiterate quite a few times that as a ceasefire between Hamas and Israel is not going to necessarily make owners go through that region, anytime soon. The Houthis are kind of a completely different thing, and a ceasefire is at least in the beginning, it's going to be temporary. And as a ship owner, we can't kind of change our conduct based on just temporary kind of agreements. We talk about long voyages. You contract a ship out for 30 to 40 to 50 days. We all know that a ceasefire between Israel and Hamas can quickly end within that period of time, and then if the ship is on its way, it's on its way. So I think kind of there, at least I try to communicate that this is not kind of an easy fix. It's going to take time, and you probably need to have kind of a fairly quiet period in both Red Sea, Gulf of Aden, and there has to be some sort of stability between Israel and Hamas, at least for a quarter, before owners will kind of change their attitude to taking the risk going through. There was also some focus on the dark fleet, Iran, Venezuela, the gray fleet, Russian traders, so forth. I think kind of the thing to point out there is the more recent news coming out of Denmark. 2.5 million barrels per day pass through the Danish Straits, coming out of Baltic, Russia. Kind of how they conduct or start to focus on insurance on the vessels passing through, that can actually be disruptive for the export of Russian oil. But we also do see the Russian fleets are ever increasing, and the latest news is that they're starting to look to after the the most recent sanction rounds which will affect LNG, we're actually seeing the potential for a kind of a dark fleet of LNG tankers, evolving. Frontline specific, a lot of questions on the dividend. We paid out 100% of our adjusted net income in Q1, and whether if that was a new rule, it's not. We don't have a firm policy on dividends, but we have said or communicated that one should expect about 80% of adjusted net income to be distributed. And it will be dependent on the board's kind of position at the time, visibility and how we see the market. We report fairly late, so we have good visibility for the following quarter. There's no kind of Frontline will never retain a lot of cash. Our philosophy is to return the cash to shareholders, and then you can decide whether if you want to reinvest or not, or invest in other asset classes or whatever you want to do. But you should not expect 100%. You should have 80% in your model if you would need something, and then be positively surprised if it ends up being 100%. So I think that was kind of the key takeaways. It's a lot of the same themes like last year, but last year there was also a lot of focus on the potential hard landing for the global economy. This was not the theme at all this year, which I guess we could deem positive.
We've also seen that you've been tweeting on the Strait of Hormuz. What's the latest there?
Nothing new there, to be quite honest. There was a debate when things were escalating between Israel and Iran, and when tension was, when they were shooting rockets at each other. What if you close the Strait of Hormuz? That's a significant, would be a significant thing for both oil and the shipping markets. But I think initially it's probably going to be very bearish tankers. You're talking about between 16 and 17 million barrels of oil per day. That suddenly gets locked in. But then, huge efficiencies is probably going to develop as one tries to get this oil out. So jokingly, you should go short tanker stocks and go long oil on such an event. But I don't think there's a scenario where the Straits of Hormuz can be closed for a very, very long time. I think we have to remember the importance of oil for China, and China have kind of relationships with Iran as well. So I think kind of the global political pressure for that actually not happening is huge. We also have to remember that it's a very kind of solid revenue stream for Iran to have the ability to export their oil. So
yeah, you also mentioned that the focus was a bit different on the Marine Money conference. There was not such much focus on the global economic slowdown, and we also spoke about 1 year ago. What would you say are the main differences today from back then, from last time when we spoke?
I think, and you tend to forget things fairly quickly. Last year we were actually still seeing China recovering out of COVID, and we were a little bit disappointed in the development in Chinese demand. Now they're firmly back above pre-COVID levels. Statistics on air travel is back at kind of all-time high. We're also seeing global oil demand, supposedly, according to EIA, we're at 103.85 million barrels per day in June, which is also kind of, we were still on the kind of recovery path last year. Now, we're fully, the kind of the oil consuming world is back to normal. I think another, theme that has come up, and we've obviously focused on it a little bit. India has come through as kind of the big growth country for both oil and coal, but for us, oil is relevant, and that's kind of it's been a gradual development over years, but it's accelerated over the last couple of years.
Let's look a bit into the fleet side, and looking at your last report, the Aframaxes did best in the first quarter, whereas the VLCCs make up the biggest share of your fleet. Could you recap? Could you start off by recapping a bit the market conditions where your fleet composition performs the best?
Yeah, no, the kind of the why the LR2 Afras are outperforming the other asset classes is it was firstly this was a Russia thing. Logistically, Russia can only cater for Suezmaxes and Aframaxes in their oil export, and obviously as that oil could no longer go to Europe or US, it had to travel much further. So that was basically this is kind of 2021 2022 story. Then this has been further kind of prominent now with the disruptions in passing the Red Sea, which in particular affecting the LR2s. We had expectations that when that kind of this situation started to evolve in December last year and into this year, we actually had an expectancy of this affecting all asset classes quite positively. But what we've experienced is that oil in particular has started to trade more regional. So instead of kind of it incurring longer ton miles, it's potentially incurring marginally shorter ton miles. AG West trading into Europe has more or less come to a halt, basically offering more oil going from the Middle East to North Asia. And so that's kind of a trade that's almost come to a halt. And then Libyan crude, Black Sea barrels and so forth looks to be staying local in Europe and the Northwest Europe instead of going to the Far East. But for the LR2, for the products, the long-term trend is obviously in place. Refining capacity kind of being or eroding in Europe and to some extent in the US as well. Capacity growth happening in the Middle East and Asia, and basically that route from Asia Pacific into Europe has increased, and well, it's not only increased, but now the ton miles have increased significantly, basically because you need to go around the Cape of Good Hope rather than going through the canal.
Could you talk a bit about the Aframaxes in your fleet and the product tanker optionality you got and how you're taking advantage of it?
Well, basically, so we have 18 LR2s, of which 4 are out on long-term time charter. So of the remaining 14, 12 are trading clean right now. So basically, we've increased the clean portion of our fleet because obviously that offers the best returns. There are about 450 LR2s in the world. At any given time, historically, you would have close to 300 trading in the products market, the rest of them trading dirty. But now, that number has probably increased to 350, 370. The rest of the LR2s are potentially disqualified to be clean vessels because they're coated, yes, but the quality of the coating may be in a state where you can't really do high yield or high end products in your tanks. So basically we've seen a big shift into clean then, basically because of the economics in that trade. But we've also seen, and we've done it ourselves, we also seen Suezmaxes clean up in order to cater for transporting a larger bulk of products east to west. When you clean an uncoated Suezmax, there's a limited amount of what grades you can carry, but typically diesel you can do that. So I think we've seen that the dynamics between the segments and the substitution factor kind of has increased, and this is what's putting a lid on the LR2 market. We came into, must have been Jan-Feb, where we saw $120,000 per day on an LR2, loading in the Far East. People start to clean up. You scrambled for basically every asset that could carry something clean was taken out and then or put in play, basically making rates overall fall back or come off. And then the next iteration we went up to $80,000-$90,000 per day, and then back again, and then the last iteration we're sniffing at $70,000 a day. But again, you get when economics are there in order to clean up, you basically take out a lot of volume. So basically making these spikes last shorter and be less pronounced. But I think this is probably going to continue. But for LR2s now, when we have this flexibility, particularly so between the LR2 and the Suezmaxes, with the cleanups, we probably need to see Suezmax markets firm significantly to allow the LR2 to run up and see the 6 digits again.
What will be your expectations for the Aframax in the next quarters in terms of rates and so on?
I think we'll probably be hovering around where we are now. On our fleet, we're averaged a little bit above $50,000 a day year to date. I think that's obviously with a lot of volatility, but I think this market can continue in that way as long as the disruptions are there in the Red Sea and Gulf of Aden.
Looking at new build prices, it looks like the VLCC new builds are increasing at the fastest rate in terms of price. Could you give us some background on that?
Well, it's off the 250 shipyards in the world, there is actually only a small amount of those or number of those that can actually cater for building a VLCC. So when you have, say, 100 yards that can do an MR, you can probably count on 2 hands the yards that can actually build a VLCC. So that's basically the availability of berths, making that pricing push upwards. And also it's it's a sought after segment. We had a bit of a frenzy on the VLCC ordering side, both for VLCC and Suezmax at the beginning of this year. That basically exhausted the capacity that was there. So now we're talking about 2028 delivery if you are gonna order a ship today. I think the pricing, a part of this pricing that has happened, we talk about more or less indicative pricing because there are not that many firm contracts that have been put in for 2028 deliveries. When you're that far out in time, a lot of uncertainties are present. The prices of steel, price of parts, basically you're out in so far out on the curve that the yards need to put some fat into the numbers as well in order to make sure they don't lose their shirt when we get there.
You mentioned U.S. shale production in the beginning. Could you give us an update on what you're seeing in terms of production exports from the U.S., both in terms of shale and offshore?
Well, it seems like U.S. exports seems to have plateaued, around 4.2 million barrels per day. I think the change that we've seen in the U.S. trading is or U.S. exports is that the 2 big areas where this oil will travel is either to Asia or to Northwest Europe. What has changed is that the Northwest Europe trade is starting to become more a VLCC trade. This would be historically just Suezmaxes or Aframaxes, basically due to logistical constraints in Europe and also the pricing mechanism against Platts. But we're actually seeing VLCCs cater for that market to a much larger extent. This is actually what creates the volatility on the VLCC side is is the shift. Kind of, you can have 1 month, you can have 1.7 million barrels per day going to Europe and 900 will go to Asia, and that can flip completely within the next month, basically due to ARBs. So that you see kind of Asia takes 1.5 to 1.8 million barrels per day, whilst Europe is then starved to 700,000-800,000 barrels per day. And this is what kind of the length of those, or the difference in the length of those voyages creates volatility on the utilization of VLCCs. So I think kind of the big change, we don't expect any fireworks on volume side from the US. It seems to have plateaued, and when I go to Houston and speak to the producers, they tend to agree to that. They don't expect kind of a lot of more barrels coming out, to put it that way. But I think the trading pattern is what's making this exciting, and that Europe is such a kind of integral part of the equation. This is obviously caused by the fact that Europe can't take Russian barrels and need kind of US barrels to kind of as feedstock into their refining.
Looking at your last report, you had an interesting graph on rates where you show that a 10% increase would give a 90% increase in cash flow. Could you recap a bit how the rates environment has been so far this year, and what we can expect for the next quarters?
Well, for Suezmax, the rates are actually fairly stable, hovering $40,000 per day. But for LR2s, we've already touched upon it. It's a huge volatility, ranging from or seemingly bottoming around $35,000 to $40,000 per day, and then kind of reaching up to 70 and then back again. Currently, probably making around 50. Where we're seeing the soft spot is currently on the VLCC side. We think we can explain this by way of normal seasonality. The true things at play here, Asian refineries are in turnaround, so basically doing maintenance, which basically limits the amount of oil they take in. Secondly, Middle East, which is the biggest exporter, is also now the hottest it is during the year, and quite a bit of oil then it gets used domestically for power generation, for cooling. How big that delta is difficult to calculate, or in the old days you were talking about 2 to 2.5 million barrels per day. Now it's probably much less, basically because they use gas for power generation, but at least close to 1 million barrels per day. And we can already see it in the numbers, particularly on Saudi, that they're significantly down on export volumes for June, which are the cargoes that we fixed back in May. So the answer to your question, where kind of Suezmax is hovering and not too much volatility. The Suezmaxes are in fact a bit hurt by the disruptions in the Suez Canal. They're called Suezmaxes for a reason. The clean is its own story, but the VLCCs is very exposed to this seasonality.
And I think I saw some analysts saying that we were expecting to see up to $80,000 per day for the VLCCs this autumn. And could you maybe go a bit more into that? What's in one of the scenarios as well in your graph from the last report? How would you achieve a 30% rate jump?
There's a lot of expectations. As it was last year, there's a lot of expectations built into the second half of the year. The 90% of the global population lives in the northern hemisphere, so basically following the seasons that we are exposed to if you are in Europe or in the US or UK. It's that's when you have kind of the highest run rates on the refineries preparing for winter, creating the most demand for oil and transport. it's expected that we'll see between 2.5 and 3 million barrels of oil, kind of incremental oil demand, come this fall. We also must not forget that OPEC are actually going to start to tweak the taps a little bit. The message they sent in the last meeting was a little bit kind of confusing, because the voluntary cuts they're going to keep through 25 potentially, but they're actually going to kind of start from the planned cuts, they're going to start to gradually increase the volumes. So if you put all that together, there is good reason to be bullish VLCCs come this fall. When is always a difficult one, but I like to say that the freight market is 45 to 90 days ahead of when the oil actually lands and gets refined and so forth. But normally, it won't happen in June, but it could potentially happen in July. Because then in July, we're, at least in US Gulf, we're fixing oil that will land in September in Asia. And that's when the refineries will start to build up inventory again before they go into full runs in October, November, December.
We've talked a bit about the Middle East already, and if we get a solution here and we get back to business as usual, what do you see as the effects on the rates?
Well, it's that's kind of the kind of silver lining here is since we haven't had a bull market on the V's relating to the disruptions in Red Sea, Gulf of Aden, I don't think we should expect it to be particularly bearish. If that situation is resolved, I think we're going to see LR2 rates normalize to a much greater extent, and Suezmaxes should be neutral as well. So I think kind of the way this looks is basically that well, if you remember back when we had the Evergreen or Ever Given, the container ship sitting across kind of blocking the Suez Canal. We got a lot of volatility within all asset classes, but this time around, it seems like the volatility has been more or less only focused on the clean trade and the LR2s. So I think kind of a resolve is not necessarily going to be it's going to be neutral.
You pointed out that the long-term charter market is on the move, and how can Frontline take advantage of that?
Well, we have kind of a rule of thumb in how we kind of conduct ourselves. So, and this was actually questions that came up in during Marine Money as well. Capital allocation. We're obviously making money now, and it looks like we're going to make money in the foreseeable future. Are we going to pay down on debt? Are we going to do this and that? Pay out dividends, and how are we going to basically prioritize? Well, first of all, we're very comfortable with the debt levels we have now. So around 50% LTVs. We're not going to pay down kind of aggressively on debt. We have no. You actually started up a couple of comments ago talking about 10% increase in rates creates 19% increase in earnings for the company or in cash generation. That number is actually now 25% because we're coming from a lower base, but it basically explains the exponential effect on cash generation when the markets move upwards, since we are a leveraged company. But what we will do as we kind of move into this cycle, which we are hugely positive for, is to secure revenue by way of time charters, and this is where this kind of interest from the time charter market comes in. It's a very liquid market now. It's predominantly 3-year contracts that the oil majors are after, but we are also seeing 5-year and 7-year deals being out there in the market. 5 and 7 years we haven't seen for ages, but I think kind of it offers decision support to investors as well, because these are supposedly the smart money, the guys that are actually short freight, like an oil major. They see the same picture as we do. They're afraid of transport capacity over the next few years, and need to secure their logistics. And another interesting thing is that historically, tankers and freight is a bit of a weird industry. You'll have a very high degree of correlation between the spot market, asset prices, and time charter rates, which actually doesn't really make sense, because an asset price is a 20-year investment, and you base it on what's happening in the week you're sitting in. But we've during the last couple of or month, I would say last month, where VLCC rates have been on the softening side, we've actually seen the long-term time charter rate appreciate, which I think is a very healthy sign. So Frontline will, as we progress, lean into that market and basically try to secure between 20 and 30% of our revenue days going forward, so that if this market fails us for reasons which are very difficult to find right now, but for sure there's risks there, we don't go bankrupt.
Great. You talk about 2024 as a year where we'll hit a wall of replacement needs, and shipping investors are well aware of the supply side story here. So I mean, what's new?
Well, it's actually not 2024 will hit the wall, but the wall, kind of, if you think about the normal lifespan of a ship is around 20 years, so somewhere between 18 and 22 years is kind of the average age of vessels kind of engaged in the spot market. 2011 was the peak building year in recent history. When I say recent history, is like the last century or something. So and that whole kind of at that time 47%. So the fleet to order book ratio was, the order book was 47% of the existing fleet. So it was a massive lump of vessels that were under construction in 2011. But it was the gradual build-up up to the kind of this peak in 2011. And we're actually not that far away from 2031, where all those vessels will actually be closing in on this 20-year. And in the same period, as I did in showed in one of the presentations, in 2011 we had 550 or thereabouts shipyards in the world. Now that's halved. So the capacity to build is not there. So if you need to replace all that fleet, and this is not only tankers, this is basically every asset class under the sun. We actually have a structural problem then, because we don't have the shipyards to renew the fleet at the pace that probably may be needed. At Marine Money, I referred to a Goldman analyst who called it the revenge of the old economy, basically a long-term underinvestment in infrastructure to cater for the oil industry, basically because we all assumed we would have been past peak oil demand already. A lot of agencies argued for 2019 to be the peak, and that we would gradually wind ourselves off oil, and the energy transition would be well on its way at this point in time. Well, it isn't, and even the most kind of positive agencies now, there's none of them that has peak oil significantly before 2030 at least. So I think kind of this is creating an opportunity in tankers, and it's going to make it very, very interesting for the next 2-3 years to see how this develops.
Moving a bit over to the Euronav vessels, and you've highlighted the positive impact of these vessels, and looks like it's been about 35% in net profit in the first quarter. And can we expect the same for the rest of the year?
Yeah, so all these ships are now kind of well in our fleet, sailing under the Frontline flag. What we did point out a little bit in our Q1 report was that When you take over such a large fleet, initially, and most of them were delivered around the Middle East or Singapore. You kind of your fleet is a little bit exposed, because basically you have too much exposure in one market. In the markets we've been now, it's actually not the Middle East to China market, the kind of the benchmark trade that has offered the best return. It's going the longer haul voyages, and all the ships we purchased from Euro now are modern eco vessels that kind of work very, very well to do US Gulf exports or Northwest Europe exports or West African, Brazil, Guyana, and so forth to Far East. Obviously, in Q1, none of these vessels could be kind of directly engaged in these trades, basically because of the delivery position. You can't ballast that amount of ships into these markets because it's a huge kind of cost to take. So basically, what we're saying is that we're going to be affected a little bit by this in Q2 as well, but by Q3, you should deem Frontline as a kind of a normal trading VLCC fleet. But these ships are giving us a very good contribution to our overall earnings. One thing to note is that Frontline now has, we have 30,000 earning days. This puts us in a great position to return a lot of cash to our shareholders should the markets kind of come in.
Great. And looks like you're up at about a 10% dividend yield currently. And how competitive is your yield compared to relative to peers?
It seems like most of us are around there. Obviously, some above, some below. I think kind of, when you look at investors and, one thing is obviously dividend yield that they're focused on. They're also focused on other metrics. Frontline has the advantage, and we're fortunate enough to be, we're by market cap the largest tanker owner out there. We are surpassed $5 billion market cap, which basically puts us in it puts us on kind of in the investment universe. We're suddenly kind of investable by far more funds. And I think that's one of the things we've noticed by the interest from particularly US investors who anything below $5 billion is a small cap or in US. We're now, for at least most of the funds, we regarded a mid cap, meaning that they can actually invest more money in our company. And also we offer very good liquidity in our stock. So I think kind of these are just as important as the yield. Maybe the yield is something a portion of the market is focusing on, and basically the main reason why they buy the stock. But I think it's more money coming in from the cyclical focused kind of energy funds and infrastructure funds, and there we are kind of the go-to stock.
Great. We discussed a bit the differences now from last time when we spoke, and you might agree with me that it looks like shipping is getting a lot more attention on the retail and on the generalist side as well. And looking back at the last boom and the valuations we saw back then, I mean, could we reach such highs again? Could you analyze this a little bit for us?
Well, there was one analyst who brought it up in the States. Kind of we trade now at it depends. Kind of the asset prices are moving very quickly here. But at least last I looked, we're trading around 1 or 20% above, 20 to 25% above NAV. So basically, we're valued 20% more than the sum of the parts. But there were actually incidents or periods in 2004 and also in 2006 where Frontline was trading twice NAV. So I think there's a lot of room kind of here to maneuver in, but it's all about kind of we have this quite great or good cash generation potential. And obviously when investors see the stock or the market firing on all cylinders and look at kind of the cash generation, which we then always will return to the shareholders, they're willing to actually pay quite a lot of money for having a piece of that. So, but I think if you also look, and this is very important to note for at least those investors that weren't in the market in the period between 2002 and 2008 or 9, is that it was a huge, although it was a fantastic period and Frontline generated enormous amounts of cash, it was also very volatile. So one quarter you think that the market is over and we're all gonna kind of go bust, and then suddenly boom, you're off for the races again. So I think kind of one has to keep that in mind. It's almost like a lot of you guys will know Nvidia and the story on Nvidia, that you could have had like 300,000% return or whatever if you were invested in that company throughout the times, but nobody would really own that stock throughout the times, basically due to the volatility. So it's a little bit like that for our market as well. It's fundamentally, I believe we can actually get into such a period, basically, but it's going to be supply driven rather than demand driven. So lack of supply of vessels is what's going to drive it, but it's going to be volatile.
Good. One more question here before I open up for questions from others. And we've gotten a bit used to the last years that geopolitics and conflicts are generating ton miles and have had a positive effect on shipping. And but what about a war situation in Taiwan? How would this affect the crude tankers?
That's that's kind of a scenario which is a little bit difficult to kind of play out, because it's going to have so many kind of effects, but not necessarily so much for oil. This kind of global polarization that we're seeing has, as you say, been kind of marginally or actually substantially in some areas positive for tankers, basically because trades tends to become more inefficient when parties don't want to trade with each other. An invasion of Taiwan or an increase in aggression between China and Taiwan, I think it's actually probably going to be more affecting retail, kind of say the container business, the car carriers, rather than oil. I can't really see how, China is short 10 million barrels per day of oil every day of the week. Disrupting that supply, that's going to have kind of severe consequences, and I would believe Beijing is very painfully aware of that.
Excellent. That concludes the question I prepared for today. So if anyone has a question, please share with us.
Yeah, I have a question. So Lars, I'm just curious for, we just saw the Houthis sink like 3 ships in a week. So, were people talking about that? Is that changing sort of the mindset? You think that we're going to see even fewer transits in the future, or do you think things have kind of stabilized where they were and people are just kind of taking the risk? Like, do you think the Houthis sinking 3 ships in a week has changed things?
I think it will, to be honest. So the ones passing now are a lot of kind of oil with Russian nexus, and owners, independent owners that kind of deal with safety for their seafarers in a different manner than we do, to put it in a diplomatic way. So the base load, you could say, through that area on the oil side is a lot of it is Russian products. I think that will have to gradually reduce, if this continues the way it has the last week and a half. Kind of for us, since we basically stopped going, when this started to get out of hand, we don't really have, I don't really have the pulse on that, to be quite honest. But for sure, it shows that there is no correlation between discussions between Hamas and Israel and the Houthis' motivation to mess up stuff in the Red Sea.
Well, I think the Houthis have stated that they don't really want to stop what they're doing until basically Israel embraces a two-state solution, which is probably never going to happen. So
yeah.
So as a follow-up to that question, my second question would be, you had Operation Prosperity Guardian. You had all of those the Western ships in the area. They were bombing Yemen, etc. And then they just kind of stopped, and everybody peeled away. The coalition kind of fell apart. Do you see any further pressure, coming from sort of Western navies, especially the U.S., or are they just going to kind of let the Houthis own the Red Sea now? Like, have you heard anything? Like, do you know what the plan is from sort of the Western navies?
I haven't. I must admit, I haven't heard anything, and I can almost jokingly say that people are getting used to going around now. So the ones that obviously have the biggest interest in this to be resolved is Egypt, because they have far less traffic through their canal, which is a huge kind of part of the national revenue stream into Egypt. But no, it's and this is also a point that I made to some of the investors over in the US as well. We as ship owners, we don't really mind going the long way around. It creates utilization. So it's a bit like cab driver. If he has to go around the block, he doesn't really mind it as long as the meter is running. So
yeah. No, for you guys, it's great. But for the United States, for Egypt, like you mentioned,
yes.
obviously they're, this is a big source of political pressure in the area now. It's basically like having like a thorn in your thumb, right?
Yeah. But I think kind of what we got from our security advisors quite early on, and I think I even tweeted about it. The word mess, a proper mess, was used quite a few times in their analysis, and I think kind of one has to have a little bit of respect for how huge this area is, how long the coastline of Yemen is, and how mobile these guys are. So it's it's almost like trying. We all know that nobody were able to really do anything to prevent kind of attacks in Afghanistan, which also has a very complicated geography. This area is much bigger, and it's so I think kind of the amount of equipment you would need in order to try and control that. I think that's pretty difficult.
Absolutely. And then my last question, as sort of a follow up to people not going through there, is there's a lot of more traffic going around South Africa now, and obviously the distance is quite a bit greater. Do you see South Africa sort of becoming let's say this goes on for 5 years? Okay, I mean, I know nobody's saying that right now that's even possible, but I'm just saying let's suppose that could be possible. Do you think South Africa could become a major bunkering hub?
I wish I could say yes to that, but I can't. And it's basically South Africa has made it very difficult to operate as a bunker supplier in the country. And actually fairly recently as well, they've kind of excluded themselves from that. So actually no, it's we are a part of a joint venture together with Trafigura and Golden Ocean, called TFG, and we then have bunkering stations spread around the world, and we had one in South Africa as well, and that had to basically stop, basically due to local regulations that made it impossible to be a bunker supplier in the region.
Well, that's very
So
important.
they need to change that at least.
Right. Gotcha. Well, I really appreciate you taking my questions. Glad that we got to hear from you fresh out of Marine Money. Looks like there's maybe a couple more in the chat.
I saw one that came up. But I saw one that came up kind of as a chat thing here, asking about cleanup of VLCCs. I don't have kind of first-hand knowledge on that, but it does make sense. Normally, when in the normal market where you actually have new buildings coming in, and we've done it ourselves as well, it's quite common on the maiden voyage to do products on a VLCC or a Suezmax. This year, there's only one VLCC being delivered to the market, so obviously that option is not really there. I've seen the reports and heard the rumors. This is a trader that supposedly have done it. They owned both sides of the equation. They have access to cargoes and obviously control the ship. I think that's very possible. But again, you can't do kind of very high grade products. You can't do jet fuel on a cleaned up VLCC. That nobody would really buy that product. But if this is going to be something that can expand kind of materially more than what we've seen, the odd ones, the couple here, the one there, I think that's going to be very, very difficult. So there's only a very few kind of players that have everything in place in order to do such a cleanup. So we've cleaned up 2 Suezmaxes. It's normally when if the ships are going into dry dock, it actually offers you a great opportunity to do that clean, and that will be attractive to the charterers. But for that to become, people have asked, okay, so is this going to pull a significant amount of VLCCs out of the crude market, but it's not. We're not going to see a massive kind of cleanup of VLCCs, nor Suezmaxes actually.
Excellent. That was the only question I had in the chat. So
I'll throw in one more here. Atlantic Basin exports. So some people are saying that U.S. is going to roll over. I've been seeing some, pretty sharp energy guys saying that the U.S. is sort of reaching the cliff on inventories. But then you have, obviously Guyana and Brazil that, it looks like they're going to pretty aggressively expand exports over the next few years. What are your expectations? What are you hearing on, what's going to come out of that area?
What would create the negative kind of spin on that would be, as you say, if U.S. exports or production first, then exports fall off a cliff. I think when I've been speaking to the frackers in the U.S., there has been a lot of positive kind of movement, in fact, by way of their kind of that whole industry has become a bit more organized. There are bigger players, majors that are involved in the fracking, and that these guys are more likely to manage to replenish depletion and keep kind of the levels going. So that's that kind of. But we are seeing, as you say, Guyana, Brazil, with really, really strong numbers. So with kind of non-OECD production or exports rather has increased by 2.5 million barrels since OPEC started their cuts, and this just seems to continue, to be quite honest. But whether if it's going to be at the same growth rate as we've seen in the last couple of years, that's very, very difficult to gauge. But one thing that we haven't touched upon is, which actually was a theme in New York, and it just came to me now, around exports, is obviously the TMX pipeline out of Canada. That's kind of a new. It's not new oil, because the hydrocarbons have been a part of the market before, but now it's being exported on the U.S. West Coast, and it's a logistical kind of complicated trade. About 650,000 barrels per day, which is going to grow up to 800,000 barrels per day, coming out in a port that can only do Suezmax, and it can't do storage, and it can't do STS. So that's going to offer an interesting kind of story going forward, where that oil is likely, well, some of it is obviously going into the refining industry in California, but some is then going to be STS, on the West Coast, further down the coast, and go to China by way of VLCC, and it's quite an inefficient trade. It takes time, so that that can be an interesting one going forward.
So you think maybe a few old boats get parked there for storage, and then STS transfer the rest?
No, you can't park them there. So you actually need to, so basically what we've seen now, and is that the oil goes down, some gets discharged into refineries in or around LA. And then it goes further down, and there is an oil stream coming out of East Coast Mexico, which cater for a VLCC. And that's a very good STS location. So, and then you get some TMX oil, some Mexican oil, and you sit there for 30 days until the VLCC is full, and then you go to China. So, but to have like a parked floating tank up in the area around Vancouver, due to harsh weather and so forth, is actually not really possible.
And what trade is that displacing? Would that be like taking Colombian oil or Venezuelan oil going across the Trans-Panama pipeline or through the canal?
Some of it, yes, but it's also, so in the replacement, yes. But this oil is then taken away from the U.S. Gulf Coast, because it was formerly transported by way of pipelines down to the Gulf, and it could actually mean that U.S. potentially needs to import a bit more, because this crude is exactly what the U.S. Gulf Coast needs. They can't just frack shale. They need these kind of medium to heavy barrels, which they're currently importing as well. But now they're losing kind of that, and it's because it's ending up on the U.S. West Coast.
So what do the Canadians get from the port? Why would they prefer to send it out the West Coast instead of you sending it through the pipeline network down to the Gulf Coast?
Well, basically, since this pipeline was canned, the XL something, I can't remember the name now. They needed to find an option to and they can also then, if you only have one client, it's difficult to price your crude. Now they have two, so it makes it a bit more efficient on pricing. Keystone XL, yeah. So the expansion of Keystone XL that was canned. And obviously production is increasing up there. Then this pipeline became a very, very good option to get this oil to the market.
Gotcha. Thanks. Looks like there's one other question from the audience about the Russian dark fleet. Prolonged sanctioning. I think we just saw some additional sanctioning as well. So any expectations there on dark fleet secondhand purchases? How long will those ships trade? Will they not trade in certain places? Just any color on sort of Russian sanctions expectations.
Yeah, no, we continue to observe that this fleet is ever growing, and with the latest additions, or rumored that Russian interest has also started to pick up kind of aging LNG vessels, old steamboats. That would be a new one, because the last iteration of sanctions is focusing on the LNG trade. But yeah, we see this kind of gradually growing, not as aggressive as it was a year and a half ago, but it's still there. And I think just the lack of recycling or scrapping, just it tells you that there is a constant bid out there for tonnage coming to age, and that is 99 out of 100 times ending up in the Russian trade or Iranian trade, or potentially also the Venezuelan trade.
So yeah, then my last comment, I was trying to, sort of come up with my own ideas on how long does the bull market last, and how long is it until the order market or the order book can really start to affect the market. And the most probable year that I came up with where maybe things start looking a little shaky is like 2028.
Yeah.
What's your, do you have a year in mind, a number in mind? What's your, how long does it last?
No, but I agree with you, because 2028 there's still plenty of capacity to build vessels. Why nothing is happening there right now is basically because of the time. It is 4 years out. Difficult to price both parts and labor and material. But I think kind of what and I've said this a few times. I'm right now we have the supply situation is known. We assume demand is going to move in line with what the experts say. So you can have a pretty high degree of confidence that we're at least not going to be in a lot of trouble for the next 3 to 4 years. But it depends on what happens in the meantime, because if we see $200,000 per day on VLCCs next year, that order book is going to swell, a lot. So because I'm 100% sure that we're going to manage to overbuild this market again.
What needs to happen for VLCCs to get tighter? I mean, I think that's kind of what everybody's waiting for, right?
Yeah. No, it's a very difficult question. And it's obviously, it's looking kind of in the mirror. You can, or in hindsight, you can kind of explain, because we were actually looking at a very, very constructive market towards the end of Q1 and into Q2. And then, this refinery, maintenance or turnaround season seems to have been fairly heavy. We also look at refinery margins, which are, they're okay, but there's nothing great. So you basically need all this oil to be transported in order to utilize to get utilization in the fleet up to levels where you can actually start to push rates significantly. So and this is why it feels like we found the floor around these levels we are now, which is, last I checked, plus minus $30,000 a day on the V. If it's an eco scrubber, maybe 35. If it's a non-eco non-scrubber, maybe 28-ish. But keep in mind that last year around this time, the rates were much lower. So I think kind of we are in this gradual grind where we have negative fleet growth in both Suezmax and VLCC, which is like the mother load of the capacity to transport crude oil. I think that will gradually kind of materialize in higher and higher rates. The volatility we're lacking is a disappointment. But I think we have to acknowledge maybe that the market has become a bit more transparent and efficient than it was maybe 20 years ago. Virtual position list, AIS tracking, all that stuff. It makes it, you can't hide vessels anymore. You can't kind of create tight spots in the market because everybody knows where your ships are and so forth. So the market's dynamic has become a bit more professionalized, I would say. But again, supply demand, the lack of supply will prevail at some point. But what's going to trigger it is very, very hard to say.
It was a huge honor to have you. Really appreciate it.
It's great being here.